Will the Fed pull off 4 rate hikes this year? Will there be a war in the Ukraine? Will gold hit $2,000? And will the DXY hit 100? These are the rapid fire questions I used to wrap up my interview today with the CEO of Santiago Capital, Brent Johnson. My name is Jay Martin. This is The Jay Martin Show. Now, we begin this interview talking about inflation and the complexity of managing this situation, whether or not the Fed will be successful at reducing inflation to the numbers they want, and where should you put your cash as a consequence. Always fun catching up with Brent, and I hope you enjoy this interview. 3 things before we jump in here. Number 1, the ad revenue from this YouTube channel is donated to an organization super close to my heart called Zero Ceiling. Zero Ceiling's mission is to end youth homelessness. The way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then support them with housing, career training, and general positive influences in their life. Number 2, I publish a weekly newsletter and I love writing it. It's free. There's a pinned comment right beneath this video where you can subscribe. I'd love to have you join the team. I share my most pressing thoughts and takeaways from conversations just like this and many others. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcast. Just search for The Jay Martin Show. Here is Brent Johnson. Enjoy.
This is Jay Martin.
What's up, guys? Jay Martin here, and I'm joined right now by Brent Johnson, the CEO of Santiago Capital. Brent, it's good to see you, man.
Thank you. Thanks for having me.
And you've relocated since I last spoke to you. Are you in Puerto Rico?
I am. I'm in Puerto Rico now. I moved here last May, and it's been a great transition. I thought I would like it, but I like it even more than I thought I would. So, yeah, family settled in, and we're pretty happy.
Okay, so it might be obvious, but so you moved from California. Talk to me about the trigger. Like, what was the trigger for you to make that move?
Well, it's a little bit of everything. I think a lot of people know that Puerto Rico has some incredible incentives if you have a business and you want to move it here, as well as for investors. And so as a result, there's been a lot of professionals that have moved here. And so there's a really kind of a big finance community here. And I was one of those people who always worked from an office, who liked working from an office, who didn't like working at home. But then with COVID, I was forced to work at home. And I realized it wasn't that bad. It worked pretty well. It was pretty efficient. And so that just kind of opened up a lot of other opportunities. And, I love San Francisco, but in some ways, San Francisco kind of broke my heart in what it's in the trend that's been developing. And, we still go back there and we have great friends there and it's a great place. But it's not the place I moved to 20 years ago. And so we've been kind of looking to do something a little different, and the timing was good for my wife and my son. So, all the things just kind of came together, and, so far so good. We'll see what happens from here, but so far we're happy with it. Yeah,
that's awesome. And, I've never lived in San Francisco, but I worked there for about 6 years in a row. I had an annual conference there. Yeah. And so even through the course of what would be, it was like 2015 through to 2020. I think that was actually the time frame we were there. You could see, I felt like I could see a noticeable shift in just like the city culture in that 5 year period of time. So did you look at Texas? Did you look at areas like Arizona, or were you just like, if we're moving, it's Puerto Rico?
That's a good. I mean, I've been thinking about something like this for many years. So on the one hand, it was very spur of the moment, but on the other hand, it wasn't all new. Like, I kind of had it gelling in the back of my mind for a long time. And, for a number of reasons, we ended up choosing Puerto Rico. I know a lot of people have chosen, to go to Texas, to go to Florida. And who knows, maybe someday that'll be where we end up as well. But we just thought an opportunity to kind of go live outside the continental United States as well. I mean, it's still in the United States. It's still U.S. territory. That also made it part of it. We kind of get immersed in another culture, but it's also still Americanized. They still use the U.S. dollar. The banking system is the same. You don't need a passport every time you go back and forth. You don't need a visa. And again, a big part of it, honestly, was the community down here. I mean, it's a really interesting community. I've met more interesting people in a year in Puerto Rico than I did in 20 years in San Francisco. And, if I would have gone to a place like, I guess if I went to Dallas or Houston or maybe even Austin, someplace like that, there would be somewhat of a finance community. But if I went to Mexico or Hawaii or Belize or somewhere like that, it would be. I feel like I would be much more on an island, not just physically, but professionally as well. And here, I don't feel like that at all. I feel like I'm very plugged in here. So from that perspective, it just kind of fit all the boxes, to be honest.
Yeah, that's fascinating. Well, it's a big move, and one that my wife and I have been discussing over the last year with like increasing consistency, because we hold passports to the US and to Canada. As you know, I'm based in Canada now. And frequently we've been discussing like what would be our trigger point to move south of the border, just based on like risk management of various, governments, and how that can vary so greatly. And, what I love about the US is how sovereign the states are. In the last 6 months, I've been to like Louisiana, Arizona, Texas, Oregon, California, Idaho, Florida. I'm probably forgetting somewhere, and how every state is a completely unique experience when it comes to risk management, and how refreshing that is, because you can really go and choose your own adventure based on what you're looking for.
Yep.
Yeah.
No, exactly.
The challenge for us has always been like, well, we also got 3 kids. You got to factor in like, you know what I mean?
That was the hardest part of the move. My son is 13 years old, and he was just going into junior high. And so on the one hand, it made it easy because he was going into junior high. He was going to be going, and there was a kind of an automatic transition there. But still, I mean, all his friends are in San Francisco, so he was not very happy with the move initially, but now he's very happy that he's here. So it's definitely challenges, but nothing that can't be overcome.
Okay, awesome, man. Well, good to hear it. Brent, let's dive in a little bit to the first 40 days of 2022. What are you most focused on right now in the macro environment, Brent? What's catching your attention, and what are you watching?
Yeah, well, I think it's clearly what's interesting to me, and I think should be interesting to everybody, is how certain a year ago, how certain everybody was that central banks would never raise rates. They would always do QE. The governments would always send stimulus checks. They would print until there was no tomorrow. And that was just a given. You weren't even able to kind of entertain the other side of it. And fast forward a year, and central banks are raising rates. Stimulus has stopped. The governments are not spending as much money as they used to. Interest rates are rising. And so, I think, and that has profound implications for markets. Now, what ultimately plays out, I don't know. But the one thing I'm not certain about anything, but one of the things I'm more certain about than others is that volatility is going to rise, and it's going to be much higher throughout this year than it was throughout the last 2 years. And that's going to present a bunch of challenges, but I think it will also present a bunch of opportunities along the way as well.
And when you say
that to me, it's the shift from even just 12 months ago mindset, 12 months ago to where it is today, and what the inflationary pressures have forced governments and central banks to do. And real quick, before I go too much further, this is kind of what I've always tried to explain, is that this whole idea of financial repression, and that the central banks are going to pin rates low and drive inflation higher, and over 5, 10, 15, 20 years inflate the debt away. It's really easy to do on a spreadsheet. It makes a lot of sense. And ultimately, that's what they would love to do. And I don't deny that. But the point I always try to make is that it's not as easy to do in real life as it is to do on a spreadsheet. On a spreadsheet, you just type in the formula, you drag the column down, and all the numbers populate, and 4 to 5% inflation over 10 years, and you've reduced the debt by 50%. I get it. It makes total sense, and that is kind of the playbook that central banks try to do. But it's hard to get just a little bit of inflation. And when you get these inflationary pressures that are 6, 7, 10, 15%, now politicians have to get reelected. It's hard for them to be sending out stimulus checks when they're also fighting inflation and the cost of living rising for their constituents. And so, markets will force government's hand sometimes. It's not, they can't just do whatever they want, I guess is my point. And so it's great to have a theory. It's great to have an idea of where things are going, but it's like being absolutely certain on anything is death, in my opinion, because it will come back to bite you. Anyway, that's a long ramble, but that's kind of that's my soapbox.
Well, that is, and that is the ideal scenario, or would be, I suppose, right? Would be to find a way to maintain 4% inflation for 15 years. And that's the solution. So you're saying there's just too many unknown variables that that affect that inflation rate. And it's not as simple as monetary policy. I mean, could be supply chain issues, could be deglobalization, could be all kinds of things. Is that what you're saying?
Not only that, but then what that stuff does to force politicians' hands, right? Like I said, I think ideally politicians would love to just spend money. They'd love to keep spending. They get reelected on that kind of stuff.
Yeah.
But when Main Street's cost of living is going up and it's only the wealthy who are benefiting from it, that's when the pitchforks start to come out, right? And that's when, the politicians, it's not as easy for them to do those policies. When their constituents are banging on their doors because inflation is high and they're protesting because they don't like the policies, it's not as easy to just do it. And so politicians will always do what is short-term politically expedient for them to do. And what's politically expedient for them to do right now is to rage against the Biden administration and their inflationary policies. And, the Republicans are not going to give the Democrats a break. Just as 2 years ago, the Democrats didn't give the Republicans a break, right? And so, you watch going into the election season. Now we've got the midterms coming up. The Republicans are just going to be beating on the table that the Democrats caused all this and they caused all this crazy inflation and Biden's out of touch. And, whether it's Biden's fault or not, I think we could all agree that it doesn't just flow back to one person. But my point is that doesn't matter. That they will categorize it as such.
Of course. Yeah. I mean, that's the game, right? And
that's the game.
There's trickle down effects of that. You talked about the midterms coming up and how hostile that's likely going to be in the back and forth, us versus them. They did it. Whatever. There hasn't really been a break, Brent, since March of 2020, maybe earlier. You could tell me if I missed something. There's just been like a trade between massive crisis to massive crisis, and not all pandemic related. Some are just massive expressions of civil unrest that have taken over cities and literally, but there hasn't been a pause. And now, I'm in Canada. The whole world is watching the Freedom Convoy. I think now 3 borders between Canada and the US are completely blocked with semi trucks and heavy machines. You said volatility is just going to increase this year. Now, were you just talking about the broad market, or are you talking about full spectrum?
Oh, I think everything. Now, as you know, I've been predicting, for lack of a better word, a currency crisis or a sovereign debt crisis for a long time now. And I've been wrong. So for all those out there who want, well, Brent's always wrong. He's been wrong for 3 years. I've been wrong for 4 years. Fine. I'm going to hold up my hand right now. And I'm going to say, you're absolutely right. I thought that we would have entered a currency crisis or a sovereign debt crisis before now, but we have not. But I still think that we're going to. And I think that as a result of that, I think there's going to be a volatility across all markets: equity markets, credit markets, currency markets, debt markets, political markets, social markets. I think, we had a lot of volatility 2 years ago at this time. And we've been dealing with a lot of social issues and economic issues over the last couple of years. But for the last 2 years, since that crazy volatility at the beginning of 2020, volatility for the most part has stayed subdued. There's been a few pockets where it bubbled up, but it never really went from one pocket to another. There was really never any contagion, so to speak, right? As soon as it flared up, maybe it flared up for a week or so, but then it kind of got tamped down. I mean, just a month ago, the VIX was back at 15. It's the lowest level in 2 years, right? Now it's come up a little bit since then. But my point is I think this year, not only are we going to have volatility spikes, but I think the average level of volatility this year is going to be at a higher plateau than it was over the last 2 years. Now, can I be wrong? Of course I can be wrong, right? There's no guarantees here, but that I think that this regime change from fighting deflation and encouraging inflationary policies to now trying to combat inflationary pressures without popping the super bubble is going to be more than the central bankers and the politicians have the capability to withstand. And as a result, I think we're going to see elevated volatility.
Right. And, what you said like 10 minutes ago, whenever you're absolutely certain of something, that's death, I think is what you said, or something close to that, right?
Yeah.
Which is like bang on, because there are always a handful of unknown variables feeding into anybody's forecast. The unknown variable by definition is unknowable.
Yeah.
And so how could you actually forecast effectively? And so what are you doing then, Brent? Because I agree with you. I feel like, so reflecting back on where we started, my wife and I are debating moving, right? Because a variety of reasons. Where we landed though was like, it's too early to tell how any of this is going to land. It's not like we go there today and we know we're good. I think that we're probably in for another 8 years of crazy uncertainty and unpredictable events that we wouldn't have guessed were possible 3 years ago. So how are you? Because you're, in wealth management, largely from a risk management standpoint, right? You manage the super wealthy's money and they're looking to not lose it. What are you doing right now, Brent? Safehavens, how are you protecting?
Sure. Well, so what I'm going to address another question that comes up a lot, or that I've gotten recently, because I think it will not only answer your question, but it'll help answer those questions that I've gotten. Is that I've had some people recently say, Brent, I've listened to a lot of your interviews over the last year or so, and it seems like you just keep saying the same thing over and over. And it's true, I do. And the reason I say kind of the same thing over and over is I haven't changed what I do that much. And I haven't changed what I do that much because I don't have to change what I do that much, because I'm not putting it all on one thing and then switching it all to another thing and then switching it all. Like, I'm not trading from one asset to another asset with an entire portfolio and betting it all on one thing. Me and my clients are very diversified. We are kind of set up in a way to be prepared for everything. And then along the way, we will overweight or underweight a sector or an asset class, and we will buy protection from time to time along the way. And not only that, we always have some kind of protection, whether it's cash, whether it's hedges, whether it's something else. But as an example, I think that this concept of the permanent portfolio, which for lack of a better word is to split your portfolio into 4 pieces, 25% cash or fixed income, 25% some kind of an equity or a company that you run, 25% in real estate, and 25% in gold or precious metals or Bitcoin or whatever it is, right? If you just did those 4 things over a 40 or 50 year period, you're probably going to do just as well as the S&P 500. Over the last 50 years, that would have been the case. You would have done just as well, maybe trailed slightly, and maybe there's going to be years where you will trail significantly, but there will also be years where you outperform tremendously when the equity markets or real estate markets or gold markets are down significantly. And so I don't necessarily have that 25, 25, 25, 25 allocation to my client's portfolio, but we use that as a guide. And the reason we use that as a guide is if you have that portfolio, you will be prepared for anything. You will at least get through anything. Now, you might not profit wildly through every type of market, but you will survive. So you will survive war, revolution, hyperinflation, deflation, recession, mini boom, mini bust. You can get through it, I guess is my point, right? And so what I'm doing now is the same thing I was doing 2 years ago and the same thing I was doing a year ago. Like, all of our clients have exposure to equities. Now, we have more hedges on right now than we did a year ago. So because we think there's heightened risk, but we even had hedges on a year ago. And now it's with a very small percent of the portfolio. And again, the idea is if you have 90 to 95% of your money invested in traditional assets, kind of those asset classes I just talked about, and you put 5% in some kind of a hedge or some kind of an asymmetric play or some kind of a black swan vehicle that pays off asymmetrically should a rogue wave or a black swan come out of the middle of nowhere and cause all kinds of chaos in the markets. And let's say your 95% gets impaired by 20, 30, 40%. Well, hopefully that 5% that you have in these asymmetric hedges becomes 15, 20, 25%. Perhaps it doesn't completely protect you, but it helps you get through those rough waters. It's kind of like an insurance policy, for lack of a better word. So we're still allocated that way. Now, I happen to think that potentially in the next 30 days and probably in the next 90 days, we're going to have a significant market event. And I mean volatility in the equity market, but not just the credit markets. And the reason is because what we talked about at the beginning is that central banks have kind of changed their policy from fighting deflation to now fighting inflation, and they're going to attempt to raise rates. Now, when I say they're going to attempt to raise rates, I say that because maybe they'll be able to pull it off, and maybe they won't. Now, what I'll say right now is I know 95% of everybody out there who just heard me say they're going to raise the rates and maybe they'll be successful are saying, no way, they will not be successful. It will cause a panic. It will cause a recession. It will cause a market crash. And they're saying it with absolute certainty. And I would just say, I'm not absolutely certain that's correct. Just like a year ago, everybody was absolutely certain they would never raise rates and never stop printing. Well, here we are. So the same applies now. Now, I happen to think that when they raise rates, it is absolutely going to cause volatility. But I'm not convinced it's going to cause a major recession or a major depression. Maybe it will. I'm not saying that it won't happen there. But regardless of whether the Fed can raise rates 2 or 3 times this year, or whether they cannot raise rates 2 or 3 times this year, if they are able to raise 2 or 3 times, I think every time they raise, the market is going to challenge them very hard.
Okay.
And we kind of saw that just a few weeks ago, as interest rate expectations started to rise, as interest rate hikes started to become more priced into the market, we had a big sell-off in equities. And it was kind of the market, it was kind of around the Fed meeting, and it was the market challenging the Fed's policy of raising rates. Now, since then, markets have stabilized a little bit. They've bounced back a little bit. But as we get closer to the March hike, I think markets are going to challenge them again. And maybe the Fed will be able to raise rates and it won't cause a big crash. And then maybe we get into June and they're going to start talking about raising rates again. The market will absolutely challenge them again. I guess that's my point is I'm not convinced. I'm not going to say the word certain. I have a high degree of confidence we're going to have another downturn in the equity markets, potentially in the next 30 days, probably, if not in the next 30, in the next 90. But I'm not convinced we're going to end the year lower in equities.
Okay.
So I think it's very possible we end the year higher in equities, but I also think it's very possible we have 2 or 3 significant drawdowns throughout the year.
So when that makes sense to me. And when you say you're expecting a significant market event, within 30 days or 60 days, that's effectively what you're talking about is pricing in those rates. Yeah.
That's right. Okay. That's right. So even if the market ultimately accepts higher rates, they will not do it quietly, I guess is the right way for me to say. It's like if you make your kid clean his room. He may clean his room, but he's not just going to walk in there and do it really quiet. He's going to argue. He's going to put up a fight, right? He may ultimately do it, but it's not just going to be a smooth transition, I don't think.
Yeah. Is this just the future of equities performance for the foreseeable future, Brent, where one individual's statement is going to dictate market activity?
Well, yeah, potentially. I mean, this is the thing is like markets are so narrative driven now, right? And it's like everybody knows that the Fed has our back. And so therefore they pay attention to every word the Fed says, right? Now, I'm not sure that the Fed has our back to the same level that everybody else thinks the Fed has our back. But, that's what the Fed is there for. And I'll take another little tangent here just to explain something. I often will talk to people and they'll say the Fed should not do that. They should let free markets figure out a price. That's fine to have that opinion, but it's important to understand that is never going to happen. Like the Fed was created and Jay Powell and all his predecessors were put in place specifically to step in when a crisis happens, right? So to think that they're not going to step in is to not understand their role, right? They are going to do that. It's just a matter of what they will do, how fast they will do it, and whether it will be successful or not. But the idea that they shouldn't do it and therefore they're not going to do it is just it's not being realistic, I guess is the right way to say it. So I think that, I think markets are going to move when ECB members say something and when the Bank of Japan members say something and when the PBOCs, I think markets are going to move on people's words rather than maybe the fundamentals. I mean, I think we could argue that if markets were just moving on fundamentals, we wouldn't be where we are today, right? I mean, they're very narrative driven. Yeah.
Okay, that's fair. You mentioned 5% of your portfolio in a black swan vehicle. Any examples, Brent? What you're looking at? What are some black swan vehicles that are worth paying attention?
Well, we actually manage a black swan vehicle, for lack of a better word. In that fund, again, I'm not allowed to go into too much detail on fund. It's a private fund, and for regulatory purposes, there's certain things that we can say and there's certain things that we can't. I will just say that in that fund, we try to find things that would have an asymmetric return if volatility picked up. So as you know, I'm a very big believer that the dollar is going to get stronger over the next couple of years. And if we enter this currency crisis, I think the dollar will benefit, or the dollar will rise in a currency crisis or a sovereign debt crisis. And because of the design of the monetary system, as the dollar rises, it puts extreme pressure on the world economy. And if that happens, then you start getting deflationary effects. And if you've got, and this is the problem, central banks are right now fighting inflationary problems, but they may have to start fighting deflationary problems. They're trying to walk this razor's edge between not letting the market get too overheated from an inflation perspective, but not falling into the abyss from a deflation perspective. And we happen to think that they're not going to be able to walk that tightrope. This is part of the reason we think that there will be a currency crisis or a sovereign debt crisis. We also believe that it's going to happen on the periphery and work its way in. So part of my, not frustration, but part of the things that I just, for whatever reason, I just can't understand why everybody is so focused on the Fed. I mean, I kind of get it. It's the center of the global economy. They are kind of the central bank for the rest of the world. So everybody's focused on the Fed and the Fed potential policy mistake. But the Bank of Japan can make a policy mistake as well. The Bank of Canada can make a policy mistake as well. The ECB can make a policy mistake. And I actually think that, it's very likely that the policy mistake comes from them before it comes from the Fed. Now, it might come from the Fed first, but I actually lean the other way. I think it'll come from Europe or Asia before it comes from the US. And when this crisis develops, I think that the US will weather the storm better than those other areas. We have those positions in place that, if this crisis starts to, show up in one area and then it causes contagion to another area, we have exposure across a number of equity, currency, credit, and commodity markets that should do very well if that happens.
Interesting. Okay. So if you were to predict or guess, Brent, will the Fed accomplish 4 rate hikes this year? You say they'll do it or they won't?
Probably not. Yeah.
Probably not 4.
Probably not 4. Actually, 2 or 3 will not surprise me at all. Not at all. Again, okay. I don't think they'll be able to easily do it. I'm not predicting 3. I'm not saying that they'll easily be able to do it. I'm just saying that won't surprise me at all.
Okay. Is the conflict in Ukraine, is that signal or is that just noise?
Probably somewhere in between. I don't think it's as much signal as a lot of people do. I think a lot of it's noise, but like I said, anything can happen. It's one of those things that you can't not pay attention to, right? I don't think that the probability of a conflict there is as high as a lot of other people I talk to seem to think it is. But it's one of those things that even if there's a small possibility that it happens, you can't ignore it because the implications of it are huge, right? And so it's kind of one of those asymmetric things, right? The likelihood of it happening are low, but if it happens, the result is very big. I don't think that Russia wants to have the conflict. I think in many ways the West wants the conflict more than Russia does. I think in many ways, U.S. Foreign policy with regards to this is extremely hypocritical. What is it, 8,000 miles, 9,000 miles from the United States to the Ukraine? But it's right next door to Russia. It's much more a Russia issue than it is a United States issue, right? There's many ethnic Russians living in the Ukraine or in Ukraine. I know you're not supposed to say the Ukraine, so I apologize for any Ukrainians listening. You're supposed to say Ukraine. I get it. Bad habit. But, to me, it's very similar if Russia was making noise in Cuba, right? It's the same thing. Like, we wouldn't like it. We wouldn't put up with it. But Russia's supposed to stand there and put up with us doing it. It's just, to me, it's hypocritical, but it's the way the world is, right? You just have to play it as it lies.
I'm with you. Okay. Probability that gold hits $2,000 this year.
I think it's low. Again, I'm ready for it. I'm one of these guys who I think everybody should own gold. You should always own gold. It's a great insurance policy. It will get you through. I don't think gold is necessarily for the crisis. I think it's so you still have some capital intact after the crisis. If we get some kind of a liquidating market like we had in 2020, I would expect gold to go down again, just like it did in 2020. I would expect it to recover very quickly, just like it did in 2020. But on the initial volatility, I would expect gold and silver to fall. But, gold, part of the reason that I'm not as bullish on gold as many of my friends and I guess colleagues who are also very long-term bullish gold is, I happen to be somebody who thinks the dollar is going to get a lot stronger. And I actually think the dollar and gold can rise together versus everything else, but it doesn't mean that when the dollar rises, there isn't some headwinds to gold.
Yeah.
And so, I'm not one of these people who thinks that the dollar's going to 70 or 60 and that it's on its last leg and it's going to die. I think that analysis is just wrong. So that's probably why I'm not as bullish gold as everybody else.
Okay. Yeah, fair.
And I should make this point is you can have things in your portfolio that you don't think are going to pay off right away. Right. And it's okay if they pay off sooner than you expect them to. That's fine as well. Right. To me, in some ways, gold is insurance against kind of financial hubris and, the ability for central bankers to walk this tightrope. But you don't really want your insurance policy to pay off. I don't know anybody who at the end of the year gets really mad that they didn't crash their car and that their car insurance didn't pay off. I don't know anybody that at the end of the year is really upset that their house didn't burn down so they couldn't collect on their insurance policy. Now, if you're 100% focused on gold and that's not your insurance policy, that's your way to get rich or that's your way to make a lot of money, well, then maybe you look at it a little differently. But that's not the way I view gold.
Yeah, nor me. It's I look at it as an insurance policy. Therefore, it's got to be safe, and safe is boring. So it's right. Boring, but it's important. Right. Boring.
Right.
I'm totally with you there. Okay, probability the DXY hits 100 this year.
I think that's a lot higher than gold going to 2000. The issue with gold, the issue with the dollar going to 100 is that, and the reason you never have really long-term bull markets in the dollar is because bull markets in the dollar crush the world economy. Like the monetary system does not work if you have a prolonged dollar bull market. Now, if it's a dollar bull market from the DXY 60 to 80, that's easier to handle than from 90 to 110. At this end, it's harder now because the global US dollar debt has gotten a lot bigger over the last 20 years or even 10 years. And so I don't think that they care much. When I say they, I mean the monetary authorities, the central bankers. If the dollar's between 85 and 95, I don't think they really care too much. But you start getting above 95, I think they start taking a look. And anything above 98, 99, that's when it really starts to put a lot of pressure on the global economy. And if you get it jumping above 100, I think bells start going off. And so then if that happens, they'll come out and they will try to institute programs to ease, the monetary pressure that comes along with a rising dollar. But I just believe that it's going to get away from them. I think we're going to get spiking dollars, whether it happens in 2022 or 2025, I don't know. I thought it would have happened by now, and it hasn't. But nothing has been done to alleviate the ability for that to happen. In fact, the problems that could cause it to go that high or to go much higher have actually gotten worse, not better.
Okay. Based on what we know now in a very short time period, talking about Bitcoin, is Bitcoin a risk on or a risk off asset?
I think it's a risk off asset.
Okay.
No, I'm sorry. It's a risk. Sorry. I said that. I think it's risk on.
Okay.
When markets are doing well and technology is going up and there's not a lot of volatility, then I think Bitcoin goes down or goes up. But when things get really crazy and you get a risk off market, I think Bitcoin falls with it.
You think so? So it's not either proven itself as the safe haven asset yet, or what are your thoughts there? Yeah. Okay.
It has not proven itself as a safe haven asset yet. And when we've had big market sell-offs, Bitcoin is typically sold off with it.
Yeah.
So, doesn't mean that it always will, but I don't think you could say that with certainty that Bitcoin is a risk-off asset and you can't point to any data that proves this.
Yeah. Too new. Is that what you think?
Yeah.
Too new? Yeah, there's no track.
Yeah. And again, in the 2020, sell-off, Bitcoin got crushed. I think it went down 75% or something.
Yeah. Okay. Awesome. Look, Brent, thanks so much for chatting with me. It was great catching up with you.
Yeah, you too. I'm always happy to talk to you. I hope you're doing well, and look forward to seeing you in person at some point.
Yeah, sounds good, man. All right. All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jaymartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.